Hey guys, another Friday, another wrap. Okay, I'm going to get into it. Last week I gave you 3 options and we had a clear winner. Investment gearing. I'm not going to try and explain it right now. It's too confusing, but it will make sense as we talk about it. All right, if ever there was a time I needed to give you the general advice warning with conviction, today is that day. Do not run off and borrow money and invest in the market based on what you hear me say today. This is a risky strategy only for certain people. It's not suitable for everybody, and you're going to find out exactly why as we go through the next 5 or so minutes. So if you want to hear more about this, give me a call and we'll chat about it and how it may be suitable or not. All right, Sam and Sue have $1,000 a month of cash flow that they want to allocate towards wealth creation. They've also got some equity in their home. So we sit with Sam and Sue and we explore options they've got. In that exploration, we drill it down to 2 different options. Option 1 is invest $1,000 a month into an appropriate investment for 10 years. Okay, they're going to invest $120,000 over the next 10 years of today dollar money. Today dollar money, you know what I mean. The alternative is to borrow some money from their home and then repay $1,000 a month, so that after 10 years, they would have paid off $120,000. So if they do that, they're borrowing $92,000. Option 1, $1,000 a month for 10 years. Option 2, borrow $92,000 from their house and pay $1,000 a month off their house or off that loan for the next 10 years. In both instances, they've utilized $120,000 of their cash flow for the next 10 years. All right, how does it play out? Option 1, $1,000 a month. 10 years, 8% return. We're ignoring inflation, we're ignoring tax. This is just a comparison between the 2 strategies to see how they go. After 10 years, they've invested $120,000 and they've earned $53,839. So in 10 years, they've got $173,000. Not so bad. What about the alternative? Well, as you can see here, they've accessed $92,665 of equity from their home via a loan. Okay, they've borrowed money from the bank, they've invested $92,665, and their repayments are $1,000 a month. So we start here with their net wealth. We get to the end and they've got $200,000. They invested $92,000 and their earnings was $107,000. How did it compare? Little bit better, not a huge amount, $26,000 better. A lot of risk comes with $26,000. So in option 1, we ended up with a total of $173,000 at the end. In option 2, we ended up with a total of $200,000. You can see this loan that we gradually paid off, got to the end, debt's cleared, $92,000 that we started with, $107,000 that we earned, and we are $26,000 better off in the strategy of option 2 than option 1. Doesn't mean that you should run away and do this. There are risks that come from this strategy. Let me very quickly show you graphically why it plays out the way it does. This is a couple of graphs I use to explain the value of time in my Your Wealth, Your Way program. $1,000 a month invested for 30 years, okay? 9% return, 2% inflation or thereabouts. After 30 years, you've invested $360,000, you've earned $773,000, your $1,000 a month for 30 years becomes $1.13 million. What if I was to grab that light blue part of the column there and lay it on its side and see what each year meant? Follow me here. Let's say if you invested $1,000 a month for 1 year only, $12,000. Came back in 30 years under the same assumptions, you're going to have about $85,000. You put in $12,000, you earn $73,000. That $73,000 is 9.5% of the $773,000. So the first year contributes 9.5% of the total. The second year contributes 8.8% of the total, okay? The first 2 years contribute 18.3% of the total earnings over that 30-year period. The last 15 years generate 15.7. It's because these guys are invested for so much longer. So it's pretty obvious, but the reason why this one becomes more is because you've got a larger sum of money invested from the beginning. Even though in this instance we only invested 92,000 as opposed to investing 120,000. So we invested nearly 30,000 less, but because we had a higher amount invested from the beginning where all of the action happens, that's where all the value comes from, the early years. So start as soon as you can and continue for as long as you can. That's the benefit. That's the reason why we earned more in the long run, because we had more money working for us from earlier. Okay. So is this a good option? Not for everyone. Absolutely not. It depends on you, your circumstances, and your objectives. There are some significant downsides that can come from this. I don't want to drag on too much, but let me give you a scenario. Let's say you started here, and I'll use round numbers. You had $100,000 of your own money, and you grabbed $100,000 from the bank, okay, as in borrowed funds, and you combine those two hundreds for a $200,000 portfolio, invested it into a fund, some shares, whatever it was, growth-oriented investments. Between the months of November 2007 and March 2009, the global financial crisis, the Australian share market reduced, or it halved in value, okay? It went down by over 50%. If you timed yourself to put some money in October 2007, your 200,000, by the time you get to March 2009, your 200,000 is less worth than 100 grand. Guess what you've got? You've got a $100,000 portfolio and you've got a $100,000 loan. So you effectively have nothing. You've got no equity. You started yourself with 100 and you turned yourself into zero. That is the potential downside of gearing, okay? Gearing will magnify investment growth and investment losses, and in that instance to zero. As we currently have, and you know, rising interest rates, it's going to cost more to service the loan. So it's going to affect your household budget. If the investment falls, as I just explained in that scenario, the debt remains. It needs to be repaid. So this is something that if you're a little bit, on edge about things, this is definitely not for you. If your household budget can't afford it, this is... I was a stockbroker during the financial crisis. I never had clients in geared funds, but guys I worked with did, and I saw it happen daily where there was margin calls. You got to put more money in, you got to sell shares. It wasn't pretty, okay? Can't stress it enough. This is not me suggesting this is a good strategy. This is just me comparing the two options. I'm all about numbers. I wanted to see how it worked. A lot of you guys did as well, and that's what we've done. If you've got a long-term time frame, if you've got cash flow, if you've got stable insurance, if you've got, stable employment, if you've got insurances, and you've got a tolerance towards growth and volatility, then it could be a strategy that is worth it for you. So there you go. More money up front is going to benefit you long term. We can see it by the numbers. All right, we had our 3 questions last week. We knocked off this one here today. We're going to go again for the balance of the two. Which one do you want to hear about next week? The tax consequences of inheritance, or where do banks get their money from and how much are they charged? Okay, if you want to know, send me an email. Everybody who sends me an email goes in the draw for the $100. Congratulations to Michael who won the $100 last week. I'll transfer that to you now. Happy Friday, guys. It's a crazy good day here on the Gold Coast. Can't wait to get outside and enjoy it. All right, talk to you soon. Bye.